Kim, thanks very much for joining us from London. In terms of the outlook, what are the key themes that you're seeing for 2021?
Yes, I think the first thing is that we think that pricing is unlikely to shift very much. We think there's a lot of money in the market, and in the search for yield across all asset classes, real estate continues to look very, very attractive. I was quite surprised at the beginning of the year to read how little you can get where you can put 1% real yield in. So hardly any high yield bonds, certainly no sovereigns. So I think for many investors, that sort of 3% nominal, 2% at least real yield that you're getting for prime real estate is going to look attractive, and we're going to continue seeing that flow of capital coming in. I think the other big thing that we're going to see is the way that what we've called alternatives or specialist sectors are really going to continue to become mainstream this year. They won't be derailed by the economic crisis or the pandemic. We're going to just see continued strong demand for things like the healthcare sector, senior living, data centres, because the structural drivers behind those are so strong now. The listed markets got ahead of the direct market in terms of investing into these sectors. So there's a lot of specialisms out there, but I think we'll see quite a lot of investment in these sectors in the coming year, particularly as we see large amounts of money being pumped into various forms of infrastructure by governments around the world. And then finally, as our other big trend for this year is the ESG trend. And it's going to be a big disruptor of the way that we do business, the way we think about business, the way that we report to clients about what we're doing. It's going to be enormously important. It's not going to be one of those things that goes away because we're doing other things that are more important. It is going to be really at the heart of all the business that we're doing. And it is going to be challenging to think about how we show that we're making a genuine impact on the ESG front. And for real estate, that's really important because the built environment is so much a contributor to emissions.
And looking at the risks, Kim, what are you seeing in terms of trends to avoid?
While we've got so much money coming into the market, which is our sort of trend to watch out for, we've also got to watch out for mispricing as well. Capital is very concentrated in a couple of very key sectors, particularly logistics and residential. And in the logistics sector, we think pricing has been quite indiscriminate. So there's been no real evidence that proper discrimination has been made between, say, urban logistics and commodity warehousing. There's been no real discrimination between markets where we can see strong rental growth can be delivered, like the big cities, particularly London, Paris, and smaller markets that are really just local distribution hubs where there's much less pressure on land and less pressure and competition for that space. So all logistics seem to be priced similarly with little regard for whether it is going to deliver growth, whether the tenants are risky or safe, and what's actually going on in those buildings and how profitable it is. And all of that actually is going to contribute to whether you can deliver rental growth on top of what are very, very keen yields. The second area that I think is really important, given that we are coming out of a very deep recession, we are going to see fairly weak demand going forward, and we're in a period of huge disruption, is that it's the wrong time to compromise on quality and location, particularly as we see these themes about the experience in offices, the need to be very flexible because companies are going to be rethinking how they use their space. If space can't be offered flexibly in great locations that offer that amenity-rich type of environment for attracting talent, then they're going to really struggle to find new occupiers when leases come to an end. And then our final thing to avoid, and I think it's been interesting that we've got a lot of feedback on this one, is the behavioural biases issue. We've lived through an extraordinarily unusual period of time. We're seeing an enormous amount of change in the way people are using buildings, the sort of buildings that are in demand. And therefore, I think we need to be really aware of our own behavioural biases. And particularly given the environment we're working in, we need to be sure that we don't have a strong recency bias, that we don't expect this year to be like last year, that we don't put too much emphasis, for instance, on our experience that we've spent the last year working from home, and therefore expect that the majority of our time will be spent working from home and offices will become redundant. I don't think that's actually what's going to happen when we are able to go back and have that face-to-face communication and that the chance to really collaborate together again. We need to be careful that we don't fall foul of things like confirmation bias, where we simply look for evidence that fits the patterns that we've been used to. We really need to look for those new and emerging patterns and think how they'll affect our investment. And we need to be aware that when we're online so much and we don't have people around us sort of checking and challenging us, and that we don't sort of just go into information overload and simply look for more and more and more data without making decisions, or simply looking for more and more data to confirm our own biases. So all those things I think are really important as we look at the decisions we make this year, because I think this is going to be a year where behavioural biases could become a real problem in decision making.
Really interesting to catch up. Thanks very much for joining us, Kim.
My pleasure.